Hello students, welcome to Principles of Accounting 1, 70201. Today's topic is about the closing process. This topic is found in your book on page 28. You may also download the PowerPoint slide from iLearning. Let's begin. Assets, liabilities, and the owner's capital account accumulate information across accounting periods. For example, the cash balance at the end of one accounting period must be the same as the cash balance at the beginning of the next period. Thus, the balance reported for cash is a result of all cash transactions since the business first opened. This is true for all accounts reported on the balance sheet. For this reason, they are called permanent accounts. Permanent accounts are all accounts reported on the balance sheet. What are the accounts reported on the balance sheet? Can you remember them? Yes. Assets, including contra assets like accumulated depreciation. Liabilities, like accounts payable, notes payable, wages payable, salaries payable, and so on. Also, capital account. These permanent accounts contain the results of all transactions since the business started. And permanent accounts are not closed at the end of the period. What about temporary accounts? Temporary accounts accumulate information for a specific accounting period only. When preparing the financial statements, only revenues, expenses, and withdrawals for this year should be reported. Revenues, expenses, and withdrawals from the previous years should not be included in this year's financial statements. Temporary accounts are accounts that are not on the balance sheet. We know that balance sheet contains accounts such as assets, liabilities, and capital. So, temporary accounts are revenues, expenses, and drawing. So these accounts are closed at the end of the period. So what is the closing process? Closing process gives temporary accounts zero balances, so they are prepared to accumulate new information for the next accounting period. Again, at the end of the accounting period, when closing process is done, all temporary accounts have zero balances. Closing process involves 4 closing entries. And to aid in the closing process, we have a new account, and that is called income summary account. So, what is the first step in the closing process? The first step is to close revenue accounts to income summary. In this example, in this worksheet, the delivery fees have a balance of $2,150. To close revenue account or delivery fee account, we have to debit $2,150 to reduce the balance to zero. Since we debited delivery fees of $2,150, we have to transfer this amount to income summary. So in effect, income summary account now has a balance of $2,150. Debit delivery fees $2,150 and credit income summary $2,150. right now the balance of delivery fees is 0 because we have already transferred the 2,150 to income summary.
Let us journalize this entry.
So instead of writing an explanation in every entry, closing entries word is written before the first entry. So the first entry is to debit delivery fees, 2,150, and credit income summary. Done. Now let's go to the second step, to close expense accounts to income summary. So each expense account is closed in this one closing entry. Let's say we have 1, 2, 3, 4, 6 expenses account. So let's say wages expense has a balance of 700. To close wages expense, we have to credit 700 to reflect a 0 balance. For rent expense, 200 debit. So to close that, we have to credit 200. And so on. Supplies expense, credit 60. Telephone expense, credit 50. Insurance expense, credit 25. And depreciation expense, 100. The balance is 0. So the expense accounts are credited to create a 0 balance, while the income summary must be debited for the total of the expenses. So the total expenses are equal to 1,135. It's like we transfer all the balances to income summary. So right now the balance of income summary is 1,015. That is 2,150 minus 1,135.
Now, let us learn how to journalize this entry. First, the income summary account is debited by 1,135. Then, all the expense accounts are credited like this.
Wages expense 700, rent expense 200, supplies expense 60, telephone expense 50, and insurance expense 25, and also not forgetting depreciation expense for delivery equipment 100. So let's try to check. 700 plus 200 plus 60 plus 50 plus 25 plus 100 equals 1,135.
The second entry is done. All the expense accounts are closed with 0 balances.
Okay. Now let's go to the third step, or the third entry, that is to close income summary to capital. So we know already that the income summary has a balance of how much? Yes, 1,015. If you notice, this 1,015 is actually the net income. All right. If you want to check, you can go back to the worksheet on the previous slide. Right now, the balance of income summary is 1,015. Credit, right? So, to close income summary, we have to debit 1,015 to reflect a 0 balance. So that's why the next entry is debit 1,015 and credit 1,015. Again, debit 1,015 in the income summary and credit Jessica Jane Capital 1,015. It's like you are transferring the balance of income summary account to the capital account. Remember, net income increases capital. So that's why, as you can see here, the capital is increased by 1,015. Okay? So right now, income summary has a zero balance. Let's journalize this entry. So debit income summary 1,015 and credit Jessica Jane Capital 1,015. Done. Now let's go to the fourth step, and that is to close drawing account to capital. Right now, Jessica Jane drawing account has a balance of 150. The entry to close drawing is to credit 150 to Jessica Jane drawing account and debit capital 150. So the balance of Jessica Jane Capital right now is 2,865. If you check the statement of owner's equity in the previous discussion, you will find that the ending balance is equal to 2,865. Now, this T account actually reflects the statement of owner's equity. As you can see, we see there is beginning capital, which is 2,000, plus net income less drawing equals the ending balance. Okay? So let's record or journalize this entry. So debit Jessica Jane Capital 150 and credit Jessica Jane drawing 150. So the closing entries are then posted to the general ledger. We have to do one by one. For example, under delivery fees. So we have to write closing in the item area to show that this entry is for closing entry. So debit 2,150. Right now, the balance of delivery fees is 0. You can use a line to signify a 0 balance, or you can also put 0 is okay. All right, after posting the first set of entries from step 1, your next task is to post the entries from step 2 to step 4 to the general ledger. For example, step 2, you have to close or you have to post all the expenses accounts, including income summary account, and also the drawing account and the capital. We can now prepare the post-closing trial balance. What is the post-closing trial balance? Post-closing trial balance is prepared only after closing entries. This trial balance or post-closing trial balance prove the equality of the debit and credit balances in the general ledger accounts. Take note, only accounts which remain open or which are permanent accounts are listed. For example, this is the post-closing trial balance for Jessica Jane's campus delivery. Cash, accounts receivable, supplies, prepaid insurance, delivery equipment, accumulated depreciation, it's a contra asset, so that's why it's on the credit side. Accounts payable, wages payable, Jessica Jane Capital. So you'll see here, the balance of Jessica Jane Capital is not the beginning balance, but the ending balance. Now we can calculate the total balances. If you observe, revenues, expenses, and withdrawal accounts are not included anymore because they have 0 balances. So take note, there are only permanent accounts on the post-closing trial balance. So we are done. We have done the accounting cycle. The steps involved in accounting for all of the business activities during an accounting period are called the accounting cycle. The cycle begins with the analysis of source documents and ends with a post-closing trial balance. So this is a brief summary of the steps in the cycle. First, analyze source documents. Second, journalize the transaction. Third, post to the general ledgers or ledger accounts and prepare a trial balance. After that, at the end of the period, we have to determine and prepare the needed adjustments on the worksheet. Then complete an end of period worksheet. Once it's completed, we can now ready to prepare income statement, statement of owner's equity, and balance sheet. After that, we have to journalize and post the adjusting entries to general journal and general ledger. After that, we have to journalize and post the closing entries to general journal and general ledger as well. And that's it. We can prepare a post-closing trial balance.